Hello and welcome to this live masterclass, Property and Your Pension for Pensions Awareness Week 2020. My name's Carol Tallon and I'm here today to keep our pension masters from getting unruly. Now, before we start, I know some of you have submitted questions in advance and we will of course get to as many of those as possible. Also, for participants here today, you're encouraged to enter any questions that you might have on into the question box on your screen. There is also an option to upvote on any questions that you see. So just to get started today, certainly I'm no stranger to Ireland's love affair with property. I actually wrote the book on it, in fact, several of them. But really, what we want to do today, we know that relationship has soured. So today we want to get beyond the emotion, beyond the barstool rhetoric, and certainly beyond the hyperbole, because the reality is that a pension is one of the most attractive ways to build wealth through property. And here to talk to us about the mechanics of that are Feargal McKenna from Beacon Capital, David Jelly from Property Bridges, Susie Nolan from Aviva, and David O'Mara from Greenman Investments. So to get started, Feargal, I'll hand it over to you.
Thanks, Carol, and it's great to have you on board to help us promote this. My day job, I guess, at Beacon Capital, I'm a director at Beacon Capital, is on how to advise people on how to borrow money for investments in real estate. And we've partnered with MoneyCube on this awareness campaign to help promote the options across not just property, but a range of things to do with pensions. And the idea behind Pensions Awareness Week is really to demystify pensions. We find that people find it very complicated. So we're trying to change the conversation about that, or at least dial up the conversation. And I guess what we're trying to do is really get the ear of the customer when it comes to pensions. So last year, for instance, we went around the country in our camper van, and we had a number of seminars around the country to really get down to ground with the people who are having experiences with existing pensions or trying to set up a pension. And we had some great feedback from that, and really that was the foundations for this year, where we have a number of different seminars. The starting out a pension on day one. Yesterday we had a session on pensions for small business. Today it's around pensions for property, or pensions and property, and tomorrow it's all about women and pensions. And there's those different themes. There's different people who have different aspects coming at it, and we want to address all of those. And I guess what we're really trying to do is get the ear of the customers out there, and get the voice of the customers, and have a bit more harmony with regards to the products that are available to people out there. And we can stop talking about a pension bomb, perhaps, and talk about the pension opportunity that exists. So why have we put property on the agenda? Well, clearly it's a very important asset class. There's a lot of reasons why property and pensions go hand in hand, and I don't think we're talking about anything new here in terms of property in someone's pension portfolio. But in my job as an advisor on people borrowing money, there's plenty of anecdotal stories that I have about people who haven't realised, as they're investing in property outside of their pension, that there were options inside their pension, and they realised quite late on that actually, had they understood the options earlier on, that there were those options to create wealth within their pension. So the idea here is really to create a platform to allow people to communicate in an open way, to bring the options to the table, and really try and get the conversation going on that piece. There's also been a lot of changes in the market. The big elephant in the room, I guess, is what's happened over the last 6 months, and I think we're going to touch on that through the session today. But there's also new products that have come to market. So when we did our bus tour last year, David from Property Bridges joined us down there, and the feedback that we got was that there was an appetite for his products through pensions, and I know since then he's launched that product. So that's quite a nice thing. And I guess the last thing is we're going to be looking at the risks in property, but maybe one of the biggest risks is actually the amount of cash that people have left on, and I think we're going to be talking about some some of the reasons why you might want to be looking at options for that cash.
Okay, that's great, Feargal. That's a big agenda for a small amount of time, and we will, of course, get through as much as we can. Now, you referred there to a product launch by David Jelly of Property Bridges, and David is, of course, joining us today on the panel. So, David, you're very welcome.
Hi, everyone. So I'll just introduce myself. So my name is David Jelly. I'm the founder and CEO of Property Bridges. So Property Bridges is an online platform that allows people to invest in property through an online medium. So we really set up to allow Irish people to invest in Irish property through the ease of a platform. So first and foremost, we're a peer-to-peer platform. So we've got 3,000 investors that have signed up with us and are investing. And we were really driven to pensions from a client need. So as Feargal said, we joined Feargal on the Pensions Roadshow last week. And there was a real thirst from our investors to give them an option to invest through their pension. So as most of us will know that investing through your pension is one of the most efficient ways to invest from a tax perspective. So we allow people to invest in Irish property through a self-administered pension, through the investment offerings we have on our platform. That's
okay.
In a nutshell.
Super, that's great. Thank you, David. And we'll move on to Susie Nolan from Aviva.
Thanks, Carol,
welcome,
and
Susie.
good morning, everybody. Thank you very much. Sorry, good afternoon, I should say. So by way of background, I am the head of property fund management in Aviva Ireland. I'm actually a chartered accountant originally, but I have been working in property now for over 13 years. So joined just at the last peak of the market. So I've seen the ups and downs, the roller coaster that is property, which I suppose really goes to the point that it is a long-term investment, and people need to bear that in mind. But I think that's why it's quite suitable for a pension investment. In terms of Aviva, I think most people will be familiar with Aviva in terms of maybe general insurance, car insurance, the Aviva Stadium, may not be as aware as the pension side of things, the fund platform that we have and the in-house property expertise that we have. So my day job, I'm responsible for a fund, diversified fund, 49 properties in the commercial space between retail, office and industrial. It's 550 million euros. And that's how people, I suppose, through their pension can access quite a diversified portfolio of properties, which hopefully then will help de-risk the investment because it is quite diversified and gives a nice income play. So that's kind of what we bring to the market through Aviva and through the pension platform that we have.
That's super. Thank you, Susie. And we're definitely going to come back and speak more about that later on in our masterclass. And last but by no means least, joining us on the panel today is David O'Mara of Greenman Investments. David, you're very welcome.
Thanks very much, Carol. Delighted to be here. Just a bit of background on myself and Greenman. So Greenman is 15 years old. We are a Dublin headquartered investment manager, and we're very much specialists in the food retail space. Our Greenman Open Fund is the biggest food retail fund in the German market. It has assets of a little over 800 million. 70% of our investors would be through pension structures here in the Irish market. So I think what I see and how we fit in for the pension market really is that people in Ireland and in every country really, they're planning to retire earlier and live a lot longer. So there's a real need to replace that income in retirement. So our fund, the Greenman Open Fund, gives options for people to build up their pension pot in advance of that retirement event, and then also replace that income in retirement because people don't want to, I suppose, fall off a cliff edge from an income perspective when they kind of face into their well-earned retirement. So that's really, I suppose, our involvement in the pension market. It's the vast majority of our pension base comes from that, and all through the Irish broker market.
Okay, thank you so much. So I suppose really to kick us off, the purpose of having a week like this, not just an event like this, is to raise awareness because pensions, similar to property, there's a lot of myths that are quite deeply entrenched. So this is always a really good opportunity to dispel some of those. So, I'll throw it out to you, Susie. In terms of myths around pensions and things that maybe people that are commonly misunderstood, what kind of things do you hear that maybe you think are important to address?
I think there are so many out there, Carol, to be honest. But one that certainly I've heard time and time again, probably mainly from people in maybe their 30s or early 40s, is sure, don't need to worry about the pension now. Sure, we're all entitled to the state pension. So when I retire, I can tap into that. So I'm quids in, don't need to worry about the pension savings for now. Now, obviously, that's absolutely true in that you will get the state pension. But what people are not necessarily aware of is that it's maybe 250 quid a week. So it's really there to, pay your bills. It's kind of your existence. But if you want to maintain the lifestyle that you perhaps have now, it's important to start paying into the pension, even a small amount from a young age, and that you won't feel too much. And you can build that up over time. As David O'Mara touched on there, it is about, replacing your income when you retire. And also, I don't know about others, but I certainly don't plan to wait until I'm 68 to retire. So I definitely need to have a pension that I can access before then. So I think they're the kind of things that maybe people aren't aware of, the level of the state pension, and that you can't access it till you're 68. So it is important to, I suppose, shatter that myth if we can today.
Yeah, no, absolutely. That's a spot on one, and that's even without bringing in things like our rental generation and pushing home ownership out. Suddenly the state supports will look very different actually if you're involved in an inflation linked rental situation as opposed to mortgage or post mortgage. So these are all really big conversations that it is important to at least get started. Feargal, what mortgage myths have you come across in your time?
Yeah, well, I guess I spent a long time abroad and in Australia, and they have a great pension system over there. They've got the superannuation system, and the employer contributes a certain amount of your wage to your pension. So there's an automatic from the time you start working. There's an automatic kind of awareness about what am I getting as part of my package that's going to my super, and that's a term that you negotiate in your employment. And I think that over here in Ireland, when we think about pensions, we tend to think about older people. We tend to think about the retirement end of pensions, but in actual fact, if we thought like other countries that were a bit more advanced in terms of bringing that conversation earlier to people in their 30s and their 20s, we'd have a much better kind of set up here from a pensions perspective. So that's maybe not a myth. It's maybe a positioning that I think that could be corrected.
Do you think auto enrollment is going to impact on that?
It could do. I mean, it's been talked about now for some time, and will it come in? We don't know. There's other conversations around. Is that good for small businesses in terms of it puts a lot of onus on them? But from a societal point of view, I saw the benefits of an auto enrollment type system, and people in that environment enjoyed a very rich lifestyle in their retirement because they had they hadn't gone to the excesses. They were able to. It was controlled really. They had contributed to their pension pot from an early age, and the compounding effect had a huge effect.
Yeah, well, that's something that we're hoping will be a key takeaway from not just this particular event, but also the whole range of events that are taking place for Pensions Awareness Week 2020. So thank you for that. David in Greenman Investments. David, what do you think? Are there some common myths that you come across that you and your team need to dispel?
Yeah, as Susie said, there's so many, it's hard to pick one, but I definitely back up what Susie and Feargal said. I mean, they're the key things. There's a lot of ignorance and naivety about pensions out there, and a lot of people have a vague notion that the state pension will be there once you hit a certain age and you're free travel, but that will not maintain a lifestyle for most of the investors that we see anyway. So I think starting early is the key thing there. If you're to look at it from a property angle, I think property and pension, I think there's maybe a misconception that you need to have a very big pot of money to participate in a property investment. But through your pension, and we raise most of our money through a platform that actually Susie's company Aviva provide. You can invest from as little as 15,000, and the things that like David Jelly's company are doing to invest from even lower amounts. It opens up the opportunity to invest in property to a much wider base. So you don't have to be, in your late 50s, 60s to have built up such a big pot that you can invest in a property. There's a lot of opportunity there through through clever pension planning to invest in property and participate from an investment perspective at a very early stage in your retirement planning.
Okay, and actually that's a great point in terms of not needing a big pot to go investing in property. And I think, David, in Property Bridges, your company is well named in terms of Property Bridges because you absolutely bridge that gap. So you must be hearing maybe some of these pension inquiries from a slightly different perspective from your investors.
Yeah, so we would allow people to invest from €500, and I mean, one of the reasons why we set up the company was to allow people that maybe didn't have access to the property market to get involved. So, I mean, traditionally, the way to access the property market would have been through a buy-to-let mortgage or a buy-to-let property. But that's not suitable for everyone, and it's not attainable for everyone. So with a buy-to-let mortgage, you might need to put down a very large lump sum in the beginning. Then you're leveraging that by taking out a long-term mortgage. And all your eggs are in one basket. So you have to manage that property. If anything happens to that property, it can seriously impact your financial health. Whereas with our model, you can invest from €500, as we say, and you can diversify that over many different projects. So it's a different way to access the market. It's more, I think it fills a need in today's market for the younger generation and the older generation alike. So you can invest from logging into our platform and at the click of a button, really.
Yeah, very good. And certainly in terms of COVID preparedness, certainly the technology that your firm offers, you are possibly ahead of the curve would be an accurate way to describe it. So we're definitely going to come back and touch on that. But again, as we're getting started, just really to gauge the people in the room, our virtual room, so to speak, I want to throw a poll out to people joining us today. And the question is, in your opinion, who believes they know most about the property market in Ireland? Is it A, Dublin taxi drivers, B, Joe Duffy, and C, professional property investors? So vote on that, let me know what you think, and we might just revisit that later in the day if we need to. So as I mentioned earlier, we did invite, in advance of this masterclass, we did invite video questions to be submitted by video, and we have one now, and we're going to line it up for you.
COVID-19 is making a big difference with how we use property. Empty offices, people moving to the country, etc. Is this going to last? And how does it affect us in how we invest property in our pension?
Okay, that's a really interesting one, and I'm actually going to throw that out to the panel. Jump in there. You know, we know that COVID-19 is likely to have an impact, and that's going to impact our youth, which also impacts on investment strategies, which of course impacts on pension strategies. So who's going to be brave and jump in on that question?
I'll just jump in there.
Carol. Oh, go ahead. Sorry, David.
Okay. We'll get David Jelly in first from Property Bridges, and then Susie will come to you.
So just, I think it's important to differentiate what type of property you're investing in. So people tend to lump property in the same bucket, but as we know, there's different verticals within the sector. So we very much focus on the residential sector. I know David at Greenman there, they focus on food retail, whereas Aviva would have a range of different verticals that they would specialize in. So I think it's important when we're looking at COVID, to look at the effects on the different verticals. So retail is one that we would view as being significantly impacted by the onset of COVID. In terms of just things shifting to online. So it's important there just to differentiate between the different sectors. And I'll let Susie jump in there.
Thanks a million, David. No, I think you've hit the nail on the head. The different sectors are absolutely key. I would take it a step further and say you got to look at the subsectors. So even the subsectors of office are currently and will perform differently going forward, and indeed the subsectors of retail. I think what's really interesting is COVID in both office and retail. COVID is expediting or accelerating something that was already happening in both of those sectors. So for example, in the office sector, there was already a shift towards flexible working. So obviously the gentleman in the video there said, all these empty offices, they won't be empty forever. Let's just be clear about that. They're empty now because we're really at the height of the pandemic and social distancing and everything else. But we can already see there is already a push for a safe return to the office for certain percentages of people, because what we lack when we are all working from home is what we're lacking as companies is we're lacking the collaboration, the cohesion and the culture that comes from actually being in the office together. Flexible working was already coming about pre-COVID. It is absolutely being accelerated. And what you will see going forward is offices being used in a slightly different way. So you'll have more collaborative space for team meetings, for that kind of group think. And there is also, he mentioned a move to the country. What you are seeing now as well is the emergence of what we call a hub and spoke model. So you'll see companies taking maybe nice shiny headquarter locations in city centres, maybe not as much space as they took before in the city, but then setting up spoke offices in the suburbs of Dublin, but also in the regions and the commuter towns. So that then helps in terms of work-life balance. So people don't necessarily have to get all the way into the city and do that hour-long commute on public transport. They can go to more local offices. So you're seeing trends shifting there. Similarly, in the retail space, I'd maybe challenge David Jelly, even to take it a step further and break that into its subsectors, because retail does tend to get a bit of a bashing with the shift to online. But if you look at the CSO stats at the end of July 2020, retail sales were up 6.7% on the previous year. Now, you got to again look at the subsectors. So obviously the high streets are very quiet at the moment and there is some vacancy emerging, and that is going to be a challenge. But if you look at the likes of the retail parks, and again looking at the CSO stats, the likes of hardware, soft furnishings, electrical goods, DIY, those sales are all up 20% year on year. And that's because we can't go on holidays and people tend to be spending money on their homes at the moment. So the retail sector is changing. There is that online shift that was already emerging. The high street is moving to more of an experiential offering rather than actually where you go and spend your money. But things like the retail parks and no doubt David from Greenman will jump in a moment in terms of grocery quite specifically, being very defensive within the retail sector. So it is about, I suppose, getting under the bonnet. And when you are comparing property investments, even when you're comparing, say, diversified portfolios like ours, get under the bonnet and understand what the composition of retail and office is within that. There are challenges out there at the moment, but I do believe it to be fairly short-lived.
Okay, thank you so much. You've covered so much in that. That's excellent. And in fact, what's really important there is you really touched on something that I think is getting lost in some of the conversation that's happening at the moment. And that is when we talk about how we use offices, yes, they're likely to change, but the change might not be as drastic as many people are thinking. And I think you pointed there to the hub and spoke model, and that's a really important part of the strategy of how the future of work and how we work going forward. Because at the moment, the conversation tends to be office versus working from home or remote working. But what gets lost in the remote working conversation is that actually a lot of people do want to work from an office, but not necessarily travel into a city centre or into a headquarters. And that's going to be a part of the office dynamic maybe that we haven't seen before, but yet it's going to be so important for rural regeneration. And of course, when that contributes to rural regeneration, then we're into a whole different ecosystem of pensions and pension opportunities for property, whether it's through private housing, private rental or social housing. So again, a lot to take in. So I'll be interested to see what questions come in from our virtual room today. David from Greenman, you might just jump in there on some of the retail trends, because that's definitely a source of maybe some miscommunication that's going out at the moment.
Yeah, it's a good point. I mean, property is too big a catch-all, and definitely within the subsets, as Susie said, it's important to drill down not just on geographic location, but also from a retail perspective, the different sub-asset classes. So we obviously are very specialist. We focus on the food retail sector in Germany. We did that at an early stage because we wanted to have an open-ended structure that could have consistent levels of property transactions that could suit our inflows into the fund. So what we're seeing, the demand for our types of properties has never really been as strong. So for the first half of the year in Germany, there was 3.9 billion worth of our type of property sold, and that the 15-year annual average is about 4 billion. So very high demand, and I think that's investors, whether they're institutional or more retail, see kind of food retail as a very defensive asset class, and that's definitely the big attraction for us. We felt that food retail as an asset class would be something that would perform. You know, there's 83 million people in Germany, they all need to eat, so that would perform whether Germany's, you know, performing very strongly economically or if there's a downturn. Now, we didn't think that would all be stress tested in a global pandemic, but I think there's a real appreciation now as food retail as a sub asset class being quite attractive for all categories of investors, and not really a kind of an alternative asset class as it may have been kind of viewed at prior to COVID. What we're really seeing is that trends that were kind of emerging, let's say, prior to COVID, have really been exaggerated during it. And from a food retail perspective, there's been a very, very low uptake on online or e-commerce home delivery, let's say, particularly when you compare that to the UK, for example. So during COVID, there's been a swing of about 30% towards UK consumers buying more food and grocery online, and that's less than 10% in Germany. But what we are seeing is that delivery is being done from your local store. So your bricks and mortar, your traditional form of retail, it's really being serviced from your local supermarket. So the big myth, I think, in relation to food retail in particular, is that people think they order online, it goes to some distribution centre on the edge of town or the M50. That's not what happens. It goes to your local supermarket. They have to hire someone, put their stuff in the trolley, give it to a van driver who drives around all day. And that's a really expensive way to do things for the retailer. So what we're seeing, the trend emerging, and what's becoming clear through COVID is that your local store will be where you go to pick up your own stuff. It's going to be where your delivery driver picks up the stuff himself, and it's going to be where there's a click and collect type model. And that click and collect, think about it like a McDonald's drive-through. That's the really big trend that's emerging across Europe. And as an investment manager, that's what we really focus on. How can we adapt the existing properties that we have to adapt to the trends that we're seeing, and also the properties that we are buying, do they have the capability to adapt to that kind of multi-channel approach? So it's really interesting to see what's happened during COVID, because it's highlighted a lot of stuff and accelerated a lot of stuff that we would have been conscious of prior to the outbreak.
Okay, that's super. Thank you so much. So to the gentleman who submitted that question via video, I hope that all of those answers combine to give you I suppose, to put the impact of COVID-19 on property, to put that in perspective somewhat. So moving on, I want to pose another poll to people listening in today. So I want to find out and kind of get a read of the room. Which of the below methods of investing in property can be accessed through your pension, just so that people just so we can really figure out where people are in terms of their understanding. So again, which of the below methods of investing in property can be accessed through your pension? A, direct property acquisition. B, professionally managed diversified property fund. C, a REIT or a real estate investment trust or a listed property investment. D, property loan note. Or E, all of the above. So you might just take a moment there to vote, and again we will come back and revisit that before the end of our masterclass. So we have another video question submitted, and we'll line that up for you now.
Some of my friends have invested in shares through their pension, and others have invested in property. Both of them are telling me it's the way forward, and I'm really confused. Should I invest in shares, or should I invest in property? Or should I invest in my pension, and if I do that, what am I being invested in?
Okay, thank you so much for submitting that question. And I am not going to use the term barstool advice anymore, but the reality is we know that there's a lot of rhetoric going out in the area of not just pensions and property, but property through your pension. So we're definitely going to throw this question out to the experts. So, Susie, I might start with you for that question.
Sure, thanks, Carol. Again, great question. It is the kind of thing, as you said, sitting on a bar stool, people have all sorts of advice. Sounds like he should take a little bit of advice from both of his friends, in my view. So you'll hear me mention time and time again diversification. I've mentioned it in relation to property, so diversify across property sectors, but also diversify across asset classes. And obviously, that's something that Aviva brings. You can go into your pension through Aviva and invest in lots of different asset classes. But looking at equities and property, as the gentleman has asked, I suppose they're quite different. They're very different, in fact. Equities, it can be quite volatile, literally up and down over the course of a day, never mind day on day. Property can tend to give you a slightly smoother return. I think what I would emphasize as well, as I mentioned earlier, is that property is a long-term investment. So just to bear that in mind, I think, and if you look at, I think we might have a bar chart that we should be able to share. If you look at the property returns over the medium and long term, they have actually surpassed the returns of bonds and equities over the 3, 5 and 10-year time horizon. So again, when you're thinking about your pension, and certainly that gentleman's got a fair few years to go until retirement, lucky him, so he'll be thinking long term. So he can see there on that graph, hopefully, that it is a long-term investment. Equities absolutely have their place. I think it's important to understand where you are. There's a concept called lifestyling, so know where you're at now. If you're younger, you might have more appetite or more ability to take on a bit more risk, which, you know, the volatility of equities kind of brings with it. And then as you get closer to retirement, you might want something a little bit safer. And, you know, the likes of Money Cube can obviously help you on that journey as you approach retirement. One thing I just mentioned, just while we're on equities and property, and it came up in your poll question actually there, Carol, is the concept of REITs, or real estate investment trusts. Just to emphasize, if people think that by investing in a REIT they're getting property exposure, I think we might have another line graph that we can show here. Just to emphasize that REITs are very closely correlated with equities. They aren't necessarily correlated with what's going on in the local property economy. So just have a look there if you can see the two very jagged lines. That's, say, for example, Hibernia REIT, which would be quite well known here in Ireland, and it's a great REIT, absolutely. But you can see how closely correlated it is there with the Euronext Dublin Index. So very closely correlated with equities, even though it is a property investment trust, whereas the kind of orangey red line you can see up the top there, that's the Aviva Irish Commercial Property Fund. So a much smoother return, much less volatility. So just to bear in mind, you know, in terms of equities, obviously there's lots of equities out there. If you're looking at a property equity, it is correlated with equities, not with the property market. So just to emphasize that point. But I think that gentleman should take a little bit of advice from both of his mates, put it together and have a diversified portfolio. But make sure to get a bit of advice to make sure you're getting the right balance in there.
That's super. Thank you, Susie. David from Property Bridges, we might bring you in as well to get a perspective on this.
Yeah, I mean, I would just reiterate what Susie said there. If you're talking to a financial advisor, he'll tell you that your pension has to be diversified, so you need to invest over many different asset classes. So the advice there would be to hold both shares and equity. And then again, it would depend on your age. So, you know, the chap in the video certainly looked quite young. So the advice there would be to maybe take on a little bit more risk at this stage in his pension journey, and then move into lower risk and lower return assets when he's approaching retirement.
Okay, thank you for that. So again, thank you to the gentleman who submitted that question, and I hope that all of what you were thinking of has been answered there, or at least has put you on a path to go do some further research.
I might add, Carol, I think it's probably just worth adding as well. If people are looking at either property or equities, there's various different aggressiveness and stances that they can take in either of those asset classes, and that's where the financial advisor comes in. You know, you can have quite a stable or defensive type exposure to either equities or property, or you can go into quite an aggressive growth mode. And so I think it's as Susie and the other guys have mentioned, it's all about diversity, not just in asset class, but in the type of stance that you have in either if you're looking for income or if you're looking for growth.
Okay, no, that's a very fair point, and actually we might just come back on that. But now, Feargal, while we are chatting to you, where do you think our audience landed on poll 1? We asked who believes they know most about the property market. Not who knows most, but who believes they know most about the property market in Ireland. Do you believe people said A, Dublin taxi drivers, B, Joe Duffy, or C, professional property investors?
Oh, I think Joe Duffy knows everything, doesn't he? I would have thought.
Oh, that's incredibly unfair. In fact, I think we should have clarified that it was Joe Duffy's audience. But okay, our poll results said Joe Duffy only 4%, taxi drivers 16. I genuinely thought that would be higher. I've gotten lots of insider information from taxi drivers, but professional property investors 80%. So that seems good. And
Yep.
we might just check. David O'Mara, do you think, for poll question 2, where do you think our audience landed? We asked which of the below methods of investing in property can be accessed through your pension. Was it direct property acquisition, property managed diversified property fund, or professionally managed diversified fund, a REIT, a property loan note, or all of the above? What do you think our audience thought?
I would hazard a guess at the second option.
The second option was a professionally managed diversified fund. Actually, 17% of them did say that, but in fact, we have a very sophisticated audience here, and 83% of them said all of the above. So I do have a third question that we'd like to throw out. You know, again, we don't like for our panelists to have to do all the work. So for everybody listening in today, one final poll. What do you look for most when you're investing in property through your pension? So is it A, diversification, B, yield, C, capital growth, or D, capital protection? So you might just have a vote on that. And while we move into, we're running into the last 15, 16 minutes of our masterclass, and we want to get through as much as possible. So I think one of the recurring themes today has been about diversification, and I think that that's a really important one. So I do want to get our panelists' insights on that. So I suppose in terms of developing the appropriate mix, you know, what can you invest in through your pension? And David and Property Bridges, we might just start with you there.
Yeah, so I'll just go through our offerings. So through your pension, if you've got a self-administered pension, you can invest in our investment offerings. So what we offer investors is a direct way to invest in construction projects around Ireland. So you can sign into our website. All the information's up on the website. So we service the construction sector, typically small to medium-sized developers. So as people may know, it can be very hard for small to medium-sized developers to attain any sort of construction finance at the minute. And, you know, banks have pulled back from the market. A couple of alternative lenders, such as ourselves, have stepped in. So we're really there to service that side of the market. On the other side of the market, then, we allow investors to invest in those projects. So, you know, interest rates are extremely low at the minute. So we're really connecting those two groups of people. So we're allowing Irish investors through their pension or through the retail platform to invest in Irish construction projects. And typically the rates is around 8% per annum. So with us, investors can choose how much they want to invest, over what time period. They can do their own due diligence through our website. So we would publish all the information related to a particular property investment. So it's really, we would do our own robust due diligence, but then it's really up to the investor to select which investment that they want to put their money into.
Okay, that's great. Thank you, David. And David O'Mara and Greenman, we might just come to you on that in terms of developing an appropriate mix.
Yeah, I suppose we would be back again to property being too big a catch-all. We would be at a totally different end of the market. We take a very long-term buy and hold strategy, what we have. So we don't get involved in development risk or development speculation. So we would take properties that are let to kind of the leading tenants in Germany and let on very long-term leases. So as an investment manager, we're just really interested in the lease and how sustainable who the lease is with, if that's with one of the main food retailers in Germany. how long the lease is for, and the underwriting or the due diligence we do is how sustainable is that location for the long term for food retail. So we put a lot of time and effort into making sure that not just for the next 5 or 10 years, but 15, 20, 25 years, will this property that we're buying be able to generate a kind of 5.5% net return to our investors over that period of time. So what we can provide to an Irish investor through their pension structure, either on the pre or post retirement side, is the opportunity to get access to the income from these retailers. So the main retailers we deal with in Germany are Edeka, Rewe, Kaufland, and the Schwarz Group that owns Kaufland and Lidl and Aldi. So between them, they sell about 85% of the food in Germany. None of them are publicly listed or publicly traded companies. So, and they're 4 of the top 5 retailers in the European Union. So one of the only ways to participate from an investment perspective in these kind of really large and dominant retailers is to do what we do and own property and get a return from that rental income. So we really provide that income option for an Irish investor, and also crucially a geographic diversification and an investment outside of the Irish market. And I think it sits in alongside and could complement something totally different from the property perspective, like what Susie runs in the Aviva fund, and something much more kind of short term and value add or opportunistic like David in Property Bridges.
Okay, very good. And Feargal from Beacon Capital, you might just give us, I suppose, the advisor perspective on this.
Yeah, okay, and I guess one of the themes here today is about explaining some of the options that a lot of people aren't aware of, and certainly one that's coming more to the fore is the SSAPs, the small self-administered pension scheme that David spoke about, that you need to access the pension product on his platform. And I guess that's quite common now among self-employed people to take that option where they have a property in mind, to try and invest in that through their pension scheme. Now there's a lot of hurdles. There's upfront costs, additional upfront costs with setting up a small self-administered pension scheme, but the tax efficiencies are quite good. And I know that, Carol, you and I have spoken to many people, including Angus Burns over at Grant Thornton, which I think if you're watching this live is going out tonight on iProperty Radio. So there's a plug back for you. But we talked about the benefits to maybe setting up the SSAP and some of the products that you might be able to, or some of the assets that that might work quite well in a pension scheme, such as the evolvement of the social housing market, and the reason why those are quite attractive from a pension perspective, because of the counterparty risk, the long-term nature, and the passive element of those kind of transactions. So yeah, I guess it is a very niche product, and I think you need to have quite a large pot of funds in order to go after that. But somebody like MoneyCube is able to set up a self-administered pension scheme, combine it with equities and property, from a fund perspective, along with a direct property investment.
Okay, thank you for that. And Susie, we've heard a bit now about the importance of diversification, which was one of the early points you made in today's masterclass. So you might just take us quite quickly through what the primary benefits of having a component of your pension invested into property, what are the key benefits?
Absolutely. Yeah, I mean, I suppose, as I've touched on, it's diversification across all asset classes is really what you should have within your pension. And as we touched on through, as you move towards retirement, that balance will change, and that's where your financial advisors such as MoneyCube might come in. But having property in there as a component part, as you would have seen in that line graph earlier, it's quite a smooth return. Now, obviously, depending on the type of property that we're talking about, but certainly, say, a diversified property fund, like the one that Aviva has on offer, it is quite smooth. To David O'Mara from Greenman's point, it is about the long-term income. It's quite an attractive income yield of about 4.7 to 5% on our fund at the moment. So it is that kind of slightly less risky, if I can say that, way of investing in property, because it's diversified across the asset classes, as well as having the long-term income in place. but as well as having a little bit of what, say, David Jelly has on offer in terms of we do a little bit of redevelopment and some value add projects in the fund to try and drive the capital value. So with that, you get your smoothed return because you have your income yield plus hopefully some capital growth. So it is a smoothed return. So while you also might have other asset classes like equities, which would be a little bit volatile, but can give a very strong return again over the longer term. And then you probably will have some in bonds or cash, some of that kind of safer component. And it is about bringing all of that together. I mean, you can do that in obviously a multi-asset fund, but if you want to be a little bit more hands-on, particularly in those younger years where you can afford a little bit more risk, you can do that diversification yourself. So you can diversify across your types of property investment, like the 3 that are on offer today, but also very important to diversify across the asset classes. So typically, if they're uncorrelated, when one asset class is performing well, it's hopefully subventing the underperformance perhaps of another asset class. But as these are all long-term investments or medium to long-term based on the profile of the audience, I think, once you have that diversification, it should give you a fairly smooth ride towards retirement, rebalancing along the way as you get closer to that retirement date.
Super, that's great. Thank you so much. So now we have one final question that came in via video, and then we are going to get we'll get to some of the questions that were submitted here today. So we'll just start question 3.
Property is bricks and mortar, and presumably there's always an inherent value in a building. What are the risks associated with exposure to property as part of a pension?
Okay, this is a great question, and it's one that we have touched off earlier in the session so far, but it's good actually to address this head on. So, Susie, I'm going to hand it straight back to you to get started on this.
Sure, no problem, Carol. Again, it does depend on what way you invest into property. As Feargal touched on there a moment ago, there's literally, property offerings at every end of the risk spectrum. And I think we have a good mix of that, to be honest, on the panel here today. I suppose some of the obvious risks attaching with property, say, for example, one can be the liquidity risk. So that really, I think, applies to most property investments. So the liquidity risk is obviously the ability to sell the asset. So if you compare that with equities, you can trade in and out of equities every day of the week. Not the right thing to do necessarily, but you can do it. Whereas property obviously can take longer, much like when you're selling your house. It can take a number of months from when you put it on the market to when you get the cash in the bank. So I suppose what a fund approach takes is, say, for example, our fund is daily priced fund and for the most part is daily traded. So you can, as an individual, you can come in and go out. Obviously the underlying properties aren't being sold every day of the week, but there is liquidity within the fund for the most part. But there is still a liquidity risk, just to be clear. So in extreme circumstances, there can be what we call a moratorium placed on the fund, where you have to defer people leaving the fund for up to 6 months. Now, it can't be a day longer than the 6 months, so we can potentially defer somebody's exit from the fund for up to 6 months. That's the longest period you could be deferred. But just to mention that is one key risk with property, is the liquidity risk, which is just really a time delay. So it shouldn't matter too much for pension investors when they're taking that longer term view and you're not necessarily looking to access this cash on a regular basis. But that's what I'd highlight as one of the key risks. Another risk then, if you're thinking about investing in a property directly yourself, so through that SAP that Feargal mentioned, if you're buying one property yourself, now unless you're a multimillionaire, which is fantastic if you are, you probably don't have the ability to invest in some of the larger, more attractive assets with the really high quality tenants, which is very important in terms of paying their rent. You may be limited to smaller assets with maybe less strong quality tenants, which brings with it its own risk. Whereas if you go into a fund, obviously, as I mentioned, there's 49 properties in our fund. They're all, pretty high profile buildings, which you wouldn't necessarily be able to access on your own. So there is the risk if you're going down the path of going on your own, you may not be able to access those bigger lot sizes, which might be fine. That might absolutely be the route you want to go, but that route also brings with it different risks than, say, investing in the diversified fund that has the professional management team behind it.
Okay, very good. And actually, I might just put the same question over to David from Property Bridges again, just really for another perspective on this.
Yeah, I guess another important risk is the market risk. So the person who asked the question was right. There is an inherent value in property, but as we all know too well, from the history here, that the value of that property can go up and down. So it's important to understand the market and the market risk whenever you're getting involved. So like we deal with in residential property. So I think for Irish investors, residential property is an easy one to understand. We're bombarded with it in the news, and a lot of us have our own homes. So a lot of people monitor the price of property, and that's valued by other comparative prices in the area. But as we all know, that the market can go up and down. So that's a very important thing to consider.
Okay, thank you for that. Now, actually, we are running very close to our time, but I want to make sure that we do just answer a couple of questions that have come in from the floor. So just very quickly, and this is really for the benefit of our panelists here today, we had asked in poll 3, what do you look for most when you're investing in a property through your pension? Is it diversification, yield, capital growth, or capital protection? And just to let you know, diversification came in at 11%, yield came in at 46%, capital growth came in at 39%, and capital protection at 4%. And I think that's actually really interesting in the context of risk that we were just discussing. But there's a question here that was upvoted, and actually I don't know the answer to it, so I'm going to just check here with the organisers. Do we have a graph to compare property to equities over a longer term period, like 20 years? In the last decade, we went from an extreme low following the crash, which was an exceptional circumstance. So actually, I'm not sure, do we at this moment have a graph to compare property to equities over a period of 20 years? But if we do, we're probably not going to be in a position to show it here, but I will make sure that that is put together with the literature from Pensions Awareness Week and this pension property through your pension masterclass. So I'm sorry, there's a question here as well. One that we will hopefully get to here is if you're close to retirement and funds are in cash, should you hold on and get the tax-free lump sum, or should they invest in property? So who from our panel would like to take that question? If you're close to retirement and funds are in cash, should you hold on to get the tax-free lump sum or invest in property? Who's jumping in on this? Maybe Feargal.
I mean, I'll just say,
Feargal as the advisor.
Financial advisor.
I think there's no financial advice here. It's all just us having a chat, isn't it? But I think the key risk there is that leaving funds in cash at the moment is clearly where there's a negative interest rate from the ECB. If it's in euros, then I think there's just a risk. The risk is that cash gets eroded away. So to answer the specific question around whether was the question that should they invest it in property or leave it in cash, was it, Carol?
Sorry, the question was should they hold on to the tax-free lump sum or invest in property?
Yeah. Look, to be honest with you, I think it's something that the financial advisors should answer rather than a debt advisor. So we'll let them answer that question. Yeah.
Okay, very good. So I'm afraid that's all we have time for today. There are a number of questions that we didn't get to. My apologies for that. But actually, I don't know if this was pre-arranged or not, but I would ask that the event organisers would make sure that any questions submitted are answered and made available through the Pensions Awareness Week website, please. And, I personally want to thank not just Feargal McKenna at Beacon Capital and Rafe Benson at MoneyCube for really putting together such an important week for Pensions Awareness Week. And also, Feargal, thank you for joining me on the panel today. Also, my thanks to David Jelly of Property Bridges, Susie Nolan of Aviva, and David O'Mara of Greenman Investments. Thank you for being so generous with your time and your insights. I genuinely appreciate it. And also, we can see from the questions that came in that there is huge demand for knowledge around this, and that's so important because at the end of the day the whole purpose of Pensions Awareness Week and the purpose of this masterclass really so that people would know that their pension, it is their money. We want people to feel confident in in taking ownership of that and seeking out the right advice and taking action on it. So to close today, I would say there is a link going to appear on your screen shortly, and that's really for people who want to start building their financial future, what the next steps are. But for now, thank you to the Pensions Awareness Week team, and thank you to my panellists, and of course thank you to everybody for joining in and being so interactive in terms of your questions. Apologies we couldn't get to all of them. We will make sure that they're answered in on the company website afterwards. Thank you.
The team here
Thanks,
at Pensions Awareness Week Ireland would like to thank you for your participation today. And remember, whether you're an individual, a company, self-employed or an employee, your financial well-being is in your own hands. With the support of the Pensions Awareness Week team, you can take responsibility and control it. And if you want to take action now, you can click on the button below and we'll help you on your journey to start building your financial future.